Hello, my name is Bobby Jones, and I'm a retired nurse anesthetist turned apartment investor. I'm also the founder of On Call Capital, an equity firm that seeks to educate fellow healthcare providers and working professionals about alternative investing while also providing opportunities for you to do so. Now, I'd like to take the chance today to go over one of the most powerful tax benefits that you can take advantage of when you own and sell real estate, the 1031 exchange. A 1031 exchange gets its name from Section 1031 of the U.S. Internal Revenue Code, which allows you to avoid paying capital gains taxes when you sell an investment property and reinvest those proceeds from the sale within certain time limits into another property or properties of like kind and equal or greater value. This essentially allows your investments to continue growing with tax-deferred status. There is no limit on how many times or how frequently you can do a 1031 swap. You can roll over the gain from one investment property to another over and over again. And if this works out as planned, you'll pay only one tax at the long-term capital gains rate, which is currently 15 to 20%, depending on your income, and 0% for some lower income taxpayers. Now, while this is often considered to be a like-kind exchange, that phrasing can end up being pretty inaccurate. You can exchange an apartment building for raw land or a ranch for a strip mall, but this doesn't mean you can do anything you want to. The 1031 is primarily for investment and business property. Sure, the rules can apply to former primary residences under certain conditions and can even be used for swapping vacation homes, but you should make sure that you're following the rules to avoid getting caught with an unwanted tax bill. Now, this all sounds well and good, but there are some timing components to consider. 1031 swaps often end up being delayed exchanges, meaning that you utilize a qualified intermediary who holds the cash after you sell your property and then uses it to buy the replacement property for you. This three-party exchange is treated as a swap. There are two timing rules that you must follow in this case. The first is the 45-day rule. Once the sale of your property occurs, the intermediary will receive the cash. And within 45 days of the sale of your property, you must designate your new replacement property that you wish to acquire in writing to that intermediary. The next is the 180-day rule. You must actually close on the new replacement property within 180 days of the sale of the old property. Now, one potential major long-term drawback of the 1031 exchange is the large lump sum tax payment at the sale of an exchange property that ultimately isn't 1031'd into a new deal. One way to effectively eliminate the requirement to pay taxes on your deferred gains is to continue to 1031 your properties until your death. This is due to the stepped up basis concept, which is pretty powerful. The scenario works like this. You pass away, and your 1031 property is inherited by your heir or heirs from your estate. The replacement property will now have a stepped up tax basis equal to the property's current fair market value. As a result, the deferred gains are effectively eliminated. So let's look at an example. Let's say you sell your first investment for $200,000 with a $50,000 gain at sale. After a handful of 1031 exchanges, you now own property worth $2 million. If you were to pass away prior to selling the $2 million exchange property and it's inherited by your heir, the tax basis is stepped up to the fair market value, which is $2 million. If your heir decides to sell the property at the fair market value, rather than paying a capital gains tax on over $1.8 million in gains, they won't have to pay capital gains taxes at all. That could mean over $300,000 in tax savings for your heirs. Now you can see why the 1031 exchange is such a great tool in the real estate investor's tool belt. As long as you continue to implement the 1031 strategy until your death, you are able to pass on all of your capital gains to your heirs tax-free. Now that's how you create legacy wealth for your family. Now, there's a lot more nuance to this subject, which is why I recommend seeking out the help of a professional 1031 exchange company when you are selling a property. One example is IPX 1031, the largest qualified intermediary in the country. You can find out more information about what they offer at www.ipx1031.com. That's going to do it for this one. If you found this information helpful, please give me a thumbs up and subscribe to my channel. If you have questions or comments about the video, please comment down below. If you're interested in getting access to passive real estate deals or opportunities, reach out to me here or on Facebook, LinkedIn, or Instagram, or at my website at www.oncallinvestments.com. Thanks for watching, and I'll see you on the next episode.